Okay, hi everyone. My name is Richard Perry. I am the market analyst at Hantec Markets, and this is my latest webinar that I'm hosting for FX Street. We're going to be talking about just general themes, really. I mean, the BOJ, the Fed, and obviously looking ahead to the Bank of England tomorrow. Main themes, really, but just all the impacts that this is all having on forex markets, on commodities, and just talking through a few things, really. What I've got is a load of slides, so I'm going to turn off my webcam and turn on my screen share. So please, I hope this is going to work. And just let me know if you can't see this slides that I've just brought up on my screen here. So right, let me get going. Basically, yeah, key themes for your trading in the days ahead really is my webinar that I'm going to talk about, and main focus is going to be sort of towards the end on the Bank of England, because obviously that is the next key central bank to announce monetary policy, and it's likely that they're going to do some sort of monetary easing, and that's going to be tomorrow. So before I get into it, just a very quick disclaimer, because I'm going to talk about live market information, and you need to have read and understood the disclaimer. I will show it again at the end if you do not get an opportunity to see it or read it through entirely. Agenda, yeah, just generally, just a bit of a debrief on the Fed and the BOJ and how markets are impacting on the back of that, and obviously also looking ahead to the Bank of England. Other key economic events as well in the next few days. ISM non-manufacturing, we've got the services PMIs all today, so ISM non-manufacturing is a key data point today, Bank of England, and obviously not forgetting non-farm payrolls on Friday. So just general market outlook and themes, and hopefully that'll take maybe 25 minutes or so, and then I'm going to look at live market analysis of the technicals, and just to sort of go through all the forex majors, indices and commodities. And at any stage, if you need, if you have anything you want to ask me, please feel free, because I will more than welcome any feedback you have, and I hope you find it all very interesting. So let's get going, really. Takeaways from the July FOMC. Basically, the market was a bit disappointed, wasn't it? And subsequently, we've had a pretty sizable dollar correction in the wake of that. Basically, the FOMC didn't do a great deal, didn't really sort of signal any sort of positivity. Obviously, yes, we've had the Brexit decision, but there was no real sort of suggestion that from the FOMC that they were going to be imminently hiking rates in September. So the market took that as a bit of a negative, and subsequently the dollar has sold off. And what you will see, interestingly enough, let me just show you if I can find it very quickly, is you'll often see sharp moves that come in the wake of the FOMC. Here we see the 2-year Treasury yield. We can often see big turnarounds, actually, all the way back to last year, really, September. Big turnaround, big falling of the 2-year yield. A slight movement to the upside in December, but then a subsequent big sell-off. The big moves, obviously, March FOMC. Big disappointment in the fact that the market thought that they were going to be doing 4 rate hikes. Obviously, they then sort of recalibrated that to 2. And another one in April, big run up in the 2-year yield in front of the April FOMC, then sold off. And again, a big run up into the July FOMC before the sell off. So you do tend to have these knee-jerk sort of reactions to the FOMC. That can last a week or so, but then gradually the market starts to sort of regain a bit of stability again, and the FOMC, and the dollar starts to strengthen again, or that tends to have been the theme in 2016. So as you can see here, you've had the sharp sell-off on the dollar, trade-weighted dollar back to 95.25 pivot level throughout this year. Trading around that point now. Be interesting to see if that pivot level, I mean, yes, it was broken yesterday, but be interesting to see if sort of the basis of it holds, and it starts to find a bit of support. A couple of signs, there are a bit of support for the dollar today, but nothing too sustainable as yet, but certainly interesting to watch nonetheless. So basically, the FOMC for July was very middle of the road, didn't do a great deal, and it sort of still goes on about data dependency. And the fact is that the data since then has been negative. You've had Q2 advanced GDP was negative, and also since then, since Friday, we've also had the ISM manufacturing data came in pretty disappointingly as well. Not a great deal there. The core PCE also didn't pick up. But I suppose the caveat would be what would happen, what would bring about a change in the market sentiment. We got payrolls on Friday, and payrolls certainly have the ability to change situations. Certainly, we had a strong payrolls report last time out. That changed the market expectations on the Fed. Last time out with a much stronger than expected payrolls report, which also included average hourly earnings pulling higher to 2.7%. So if you had another strong payrolls report, say for example above 200,000 on the headline, you also saw average hourly earnings picking up from 2.7. They're expected to stay at 2.7 this month. But if it started to pick up again, it'd be interesting to see what the market would do, because perhaps they would start to sort of recalibrate once again. Because if you look here, I've got this static chart from yesterday. I took this meeting date of Wednesday, the 14th of December. So the December FOMC is currently priced around 43% probability on the Fed funds futures. So it'd be interesting to see if that basically effectively that means that the market is not pricing in a rate hike this year. Perhaps that's gone a little bit too far. What would happen if we got a couple of months worth of strong payrolls data? The market would then have to reprice that again, and we would see a dollar strengthening. So the market has obviously had a selling pressure through the dollar since that FOMC, but perhaps it's gone a little bit far again, or at some stage it will start to look a bit too far the other way, and you will inevitably get a strong bit of US data that I think turns the corner on this dollar once more. And perhaps it could be payrolls on a Friday. Other issues being Brexit, obviously, and the US presidential election. Brexit, we still don't know really the outcome or the real sort of fallout from the Brexit decision on major economies around the world. Obviously, we're starting to see the UK data deteriorate already, and I'll talk about that in a bit when I look at the Bank of England. But for now, we're not really seeing a huge impact across global economic indicators. Could be different if the contagion from a UK slowdown spreads, but for now we're not really seeing too much. Also, the US presidential election is so difficult to actually know exactly what's the outlook for the US will be from that election. I haven't gone into it yet in terms of preparing for the event, and I'm going to do some more work on that in the coming months. But you would imagine that a Donald Trump US presidency would be protectionist, would be anti-trade. He's already talking about pulling out the TPP. And anti-trade, protectionist. Generally speaking, isolationist is not good for global markets, really. So that will be interesting to see. But yeah, the US presidential election towards the end of the year could have an impact. In terms of the Bank of Japan, failed to deliver on Friday. Failure to discuss helicopter money. Interesting that the markets pretty much are now sort of looking towards helicopter money to be, well, probably the savior really for the yen strength that we see. Yen strength is significant. It's regaining momentum again, as you can see in my little picture here, randomly picked off the internet. Nice little yen strength against euro, sterling, and also the dollar. But basically, the market is pretty much questioning what the Bank of Japan can do. Now, it's interesting because they obviously they did the ETF purchases, almost doubled. But to be honest, no more increases in JGBs, no more cutting of the deposit rate. To be honest, the banking sector would have benefited from that, because obviously financials in Japan hit quite significantly on the deposit rate cut. in January, but it's interesting because they've also said that there's going to be an assessment of the at the next meeting of the effectiveness of their policies. So they're going to be really looking at a potential overhaul. Now, what does that mean? Well, there could be it could mean subsequently they do helicopter money, but that's still really pie in the sky at the moment. We don't really know whether that's going to happen or not. But at the moment, the yen is strengthening. And the impact of that, I mean, basically expectations were high into the July meeting. They thought that the market thought that they were going to do a lot more than they actually did. They could have done JGBs a lot more, increased to maybe 100 trillion. I've got a slide, actually, the next slide. What could they have done? Well, ETF purchases could have been 10 trillion instead of 6. No increase in JGBs. They could have been up to 100 trillion. Now, I've got a few charts here on the balance sheet of the BOJ. Now, this is the balance sheet of the BOJ up until the end of July, coming up to 450 trillion yen. Now, 450 trillion yen is there or thereabouts 450 billion. Sorry, $4.5 trillion. Now, that is basically the same size as the that's basically the same size as the Fed balance sheet, and the US economy is, well, was it 2.5, 3 times the size of Japan? So you can understand the size of the Bank of Japan balance sheet on a relative basis is enormous. Also, that's probably the one to do last. The fact that the Bank of Japan is already increasing the share of JGBs at a pretty steady rate. It's up to around about 40% now. It's expected to be sort of 50%, I think, by the end of 2017. So the Bank of Japan is steadily increasing the share of JGB market, and therefore the liquidity is actually steadily falling in JGB. So it would suggest that the markets are really becoming a bit stymied by the Bank of Japan and its policy of buying JGBs. And you'd suggest that perhaps the efficacy in terms of the markets is not all that great in terms of its policy there. So also what it could have done is extend negative interest rates from minus 0.1 to minus 0.2, minus 0.3. But obviously the banks were happy with this. But the impact on the Japanese economy hasn't been all that positive, following on from the move that it made in January. I mean, you've still got weak consumption, you've still got growth and inflation data falling. You had, for example, the Bank of Japan at the meeting just gone actually cut its forecast rates for GDP and inflation this year, and left the rates for 2017, 2018 as they were. However, it certainly shows that the immediate actions of the Bank of Japan is not really doing anything. Now, you've got obviously this huge fiscal stimulus program from the government, which is sort of 28 billion. Sorry, my mistake. 28 trillion yen, which is it's not all that it's cracked up to be, because I mean direct spending is only around about 7.5 trillion, and it's sort of, I mean, the Bank of Japan, the government actually said that the direct spending increase of around 7.5 trillion yen would boost GDP by about 1.3%. Now that has already been questioned, and the reason being that the market's sort of thinking it could only be around about 0.5% on GDP. So ultimately, maybe the government is not really doing a huge amount, and it's basically been seen a bit sort of middle of the road in terms of its extension of this first arrow, which is the fiscal stimulus arrow, and it's not really done a great deal, and the yen has continued to strengthen on the back of that. So ultimately, just going back to this slide here, what's the impact been on pulling yen pairs lower? So pulling dollar yen lower. It's not a million miles away from 100 yen now. Euro yen moving back towards 111. These are all key July lows, and sterling yen moving back towards 129. Now I do have the charts of that. Not that. You got sterling yen already pulling lower. Now this is a sell zone box that I did just before the Bank of Japan. I've just left it on there because it basically worked. Still pulling lower. Minor bit of a rebound today, but I don't think ultimately it's going to change the course. Euro yen as well. Again, a minor rebound, but again, the selling pressure has been fairly consistent through euro yen. And again, I think these a test of these July lows around 111 is likely to be seen. And dollar yen, again, a minor rebound, 101.30. Yeah, it's just in terms of in the scope of what we've seen in terms of the decline, it's very little. And I would be looking out for selling opportunities on all these pairs. 100.02 is the July low. On dollar yen, well, I mean, I'll talk about it later when I do the proper technicals on it, but dollar yen under 100 yen, that would be significant in terms of the psychology of that move. Sorry, quick drink. So what are we looking for from tomorrow for Bank of England? Well, again, markets pretty much firmly pricing in 25 basis point rate cut to 0.25. Now that would be the first rate cut since 2009, as you can see here in the small chart. I hope you can see it. It's that basically the Bank of England has kept the same headline monetary policy for the past what's that, 6-7 years. And no move on rates in that time. Now, question of quantitative easing is the issue. What would the Bank of England do in terms of quantitative easing? Well, the market tomorrow, according to Reuters, if I get the expectations, here we go. Market tomorrow is this, first of all, on the voting makeup, one leaving unchanged. Now that'd be interesting. That's likely, I'd imagine, that the Reuters are thinking that's going to be in McCafferty. And then 8 voting for a rate cut. Now the 8 is fairly significant because the one of the reasons why the market started thinking that there was going to be pretty much a nailed-on rate cut was the views of Martin Wheel. Martin Wheel has been a hawk on the Bank of England Monetary Policy Committee for a long while. He's periodically votes for a rate hike. Obviously, never got the rate hike, but still, periodically he's been voting for rate hikes. Now, this would be significant because this is going to be Martin Wheel's last vote on the MPC before he gets rotated out, and he obviously is a hawk, and if he votes for a cut, now that is significant, being his swan song as well. I mean, I can't imagine he'll be, unless he was desperate, unless he was really had to, you would be questioning whether a long-time hawk on the Monetary Policy Committee using his last vote to vote for a rate cut. That's a big legacy, isn't it, for him personally? So it would be a fairly significant event, I think, and fairly indicative of the market needing to see a rate, or the UK needing to see a rate cut. In terms of quantitative easing, it appears on Reuters that they're not forecast to extend quantitative easing. Now, I had read that someone in the market have been looking for quantitative easing. Now, figures of 100 billion sterling have been suggested, but I think they're not going to talk. I don't think they're going to do quantitative easing tomorrow. I think they'll do the rate cut. I think they'll talk about doing quantitative easing, and they'll also talk about a program of rate cuts. In my opinion, I think they'll use particularly dovish language. And I think that will prevent sterling from rising. Sterling has been rising, interestingly enough, even in the face of what seems to be an almost nailed on rate cut. I think the market has sort of fairly much come to the conclusion that there will be a rate cut. But I think it depends on the language in terms of the rhetoric, whether there'll be a significant selling pressure through sterling. Now, I think sterling's going to sell off, yes, on the back of this monetary policy decision. I think if the MPC is particularly dovish, cutting growth targets, maybe increasing inflation, I suppose, yeah, but certainly cutting growth targets would be the important one. Saying that is not going to be the last rate cut. Potential discussion of quantitative easing program further down the line, maybe next time out. Maybe they'll do an increase in quantitative easing, maybe 100 billion. But I think it will be the dovish language that sets sterling lower, if that were to be seen. So at the moment we've got sterling, which has actually rallied today, but don't necessarily think that it's going to last. I think the rate cut from the Bank of England will be fairly decisive. Now, in terms of how the markets would react to this, now it depends on how dovish the Bank of England is, but I think sterling will sell off, and I think that ultimately means it's going to retest the post-Brexit lows. 127.96 was the low on cable. Post-Brexit in the immediate aftermath of Brexit, 127.96. I think that would be tested. 86.25, the high on euro sterling. I think that would be tested. And again, I reiterate, 129 on sterling yen, I think would be also seen. Generally, across the forex majors, you're likely to also see the dollar and the yen outperforming because it'll have an interesting legacy on the others, and I'll talk about that just down below. First of all, on equities, sterling weakness and looser monetary policy for the FTSE 100 would be bullish for FTSE, I think, because as you saw in the post-Brexit moves, FTSE found support and was quite strong on the fact that it's on the weaker sterling, and the reason being because it's about sort of 70 or so % of FTSE earnings are generated abroad, and also you've got the big dollar paying dividend stocks such as BP, Shell, and those dollar dividends would be translated better into sterling on a weaker sterling. So you subsequently get FTSE 100 benefiting on the back of that. Now, expectation of loose monetary policy across the markets would also help to support DAX and CAC too. Now, in terms of gold, I think gold would also be supportive, because I think, again, it could potentially be that the Bank of England begins another wave of loose monetary policy across central banks, and that ultimately is supportive for gold. Legacy of the move, Bank of England could begin a program. Yes, it could, as is just discussed, and also other central banks could follow suit. The ECB would be the prime candidate here. I think the Mario Draghi was sort of fairly wait and see in terms of Brexit. And to be honest, the data out of the Eurozone has not been all that bad in terms of the PMIs today. They're marginally okay, marginally better than expected. But it'd be interesting to see what Draghi does in the wake of a Bank of England rate cut, because obviously that should theoretically strengthen euro sterling. So yeah, it'll be very interesting to see if the ECB then follows suit. Other banks could also act. People's Bank of China, interestingly enough, did a little bit of a cheeky easing around the Brexit time. It could be following suit again because of the dollar strength. You'd also see possibly the RBNZ, possibly the SNB. I mean, these are all possibles following suit as well. And other data points to watch out for this week. We got ADP employment today in about just under 2 hours. Now, you had the ADP data last month, which wasn't great in terms of forecasting payrolls. I mean, ADP last month was 172. I think payrolls came at 280 odd. So it did a pretty rubbish job of calling the payrolls report, but still the market generally does take a little bit of notice of the ADP. So watch out for that today. ISM non-manufacturing is always interesting. It actually rose pretty strongly last month to 56.5, but the forecast today is 56.0. So let me just get these forecasts. 56.0. Here's the ISM. It's not great because annoyingly my Reuters charts have changed in terms of how I can get the data out. But yeah, the expectation for today is 56.0, which is down from the actual of last month, which was 56.5. And EIA oil inventories. Oh, where's that gone? EIA oil inventories. Now, we had a surprise inventory build last week, or last announcement. It's expected to come back down, actually, 1.25. Interestingly, this week is also expected to have another cut. Inventory drawdown, but the oil price does move off these inventory numbers, so it creates the volatility there. Now, in terms of tomorrow, we've got Bank of England and factory orders. Factory orders in the States have been pretty negative, actually, since 2014, and it certainly doesn't bode especially well for the manufacturing sector there. And payrolls report on Friday. Now, obviously, payrolls are the big numbers to watch on Friday. Let me see if I can get you the payrolls data. Non-farm payrolls, massively better than the market had been anticipating last month. It'd be very interesting to see if it comes in again. The expectation is for basically back down towards this. This is the 6-month moving average of payrolls. 100, and I think the expectation is 170, 180. See what the actual expectation is according to Reuters. Non-farm payrolls 180, according to Reuters. So yeah, basically back towards that 6-month moving average. Now, in terms of other indicators, you've got unemployment, which ticked mildly higher last month to 4.8%. No, 4.9%. Sorry, and that was interesting because that had an impact on the participation rate. The participation rate picked up on the fact that the unemployment rate, basically the other way around, really. But more people looking for jobs in the States basically means that more people are added to the employment calculations. Therefore, unemployment went up. And average hourly earnings, again, as per usual, is forecast to be 0.2% for the month. Now, that actually is in line with what the average hourly earnings year-on-year data would be, so, as in 2.7%. So it looks on the forecasts, or on the consensus forecast, as though it's going to be a pretty middle of the road payrolls report. It doesn't look as though the market is expecting a massive blowout. But yeah, it'll be interesting to see how this all pans out. So yes, okay, well that's half an hour. Happy days. So I will now have a look at some charts. Okay, so let's start off with the euro. Now, we've had a strong gain on the euro in the wake of the payrolls report. Let me just zoom in a bit better than that, so you can see it. Strong move higher on the euro dollar in the wake of the payrolls report, FOMC, in the wake of the FOMC. So we've added from a low of sort of 950. Wow, that's like almost 280 ticks to yesterday's high. So that's a really strong move in euro dollar in that past week or so. Now, is this a sustainable rally? I generally don't think so. I think this is a rally that's going to fall over. I mean, I have been saying this for a while. Basically, I've been still on the strategy of selling into strength on euro dollar for a long while, actually, pretty much the last few months. Yes, this rally has gone further than I thought, but it'll be interesting to see if again if the RSI again fails around this 60 point, the MACD lines start to fail around neutral again, because the stochastics are now into positive territory. So that suggests we're strong with the near-term uptrend or the near-term bull run. But it'd be interesting to see if it can sustain the move, because I will be surprised if it does. I think that I'm sort of the expectation that I think payrolls could be the number that turns it all around again. So I think we need to watch out for that payrolls report, obviously, that we could see some profit taking just setting in on euro dollar on the back of that. But ultimately, near term, the outlook is positive. But you look at the momentum indicators, having throughout January, February through to May, we saw the MACD lines all positively configured, and then we saw them drop below in May after that selling pressure came through, and then the rallies started to be sold into. And ultimately, I still think that we're in that phase. Having broken that uptrend channel, I think that uptrend channel becomes the basis of resistance. That's currently around sort of 1290, but sort of 13-figure area. But I think that it could be that this is around about the sort of level. I mean, I have been saying that for a couple of days now, and I am surprised how strong the euro has been in that time. Another chart to show that the dollar weakness that we've seen in the last sort of few days is sterling. Now, sterling has jumped, and you could even argue if sterling broke above 35.33, which is this reaction high here, that would actually provide us with a head and shoulders reversal. I don't think it's going to happen. I think this rally in sterling is going to roll over, and I think we're going to see selling pressure coming back through with the Bank of England, which is, as I said, likely to have a rate cut and also likely to include dovish language, in light of the fact that we've had sort of PMIs. I mean, the services sector PMI 47.4 today. That was a 43-month low. Obviously showing how the market is now sort of really concerned about Brexit, and the PMI data has reflected that. And I think this little near-term rally we've got on sterling, I think that's going to fall over. 33 figure is an interesting support near term. I can actually show you that on the hourly chart. $33 figure. It was a sort of breakout level, but also general sort of pivot. So I turn that off. There you go. So general pivot around 33 figure. And we come back to find support at that and bounce again. So near term, you'd say sterling's pretty positive technically. The hourly RSI finding support in the sort of 40 area, high 30s towards 40. Little near term correction. I mean, we're sort of looking as though we're going to be breaking out again. 33.69. Yeah, it actually has broken out just in the last few minutes. So that would argue 34.80 could be on in terms of the near term, but I think that the Bank of England will take this steam out of this rally, and I think it will be sold off. But for now, near term, sterling looks pretty positive, but I don't think it will last. Dollar yen again, technicals all negative across the board. Downtrend channel. Moving averages are falling in bearish sequence. RSI failing at 60. MACD lines crossing negative at neutral. Stochastics in bearish configuration. I think it all points towards a retest of 100 figure. Any rallies you get, I think, is a chance to sell. You've had a little near-term one today. Little near-term rally, but look in the context of how the market has moved in the last sort of a couple of weeks, certainly since that BOJ decision anyway. Selling pressure, any rallies are being sold into. And I think that this, you get a pretty decent sort of band of resistance, 101.95 up towards 102.85, which is a bit of a pivot, marginally pivotal there, but I think ultimately that it was the low on this day here, which was Friday 29th, and then subsequently capped the gains yesterday as well. So you got 100 ticks worth of sort of near-term key resistance, I think, of sell zone, I think would be ideal if you did see a little bit of a near-term uptick. But again, looking at these hourly indicators, having been throughout the rally, you saw the MACD lines nicely supported around neutral, and then you started to see around the top, you started to see the MACD lines going negative, and you started to see them then failing around that neutral level and going much deeper into negative territory. So it all sort of hinted at the turnaround at the top, and we started to see that. So I think generally speaking, this little unwinding rally that we've got today probably is going to give you a nice little opportunity to sell again, because around 60 on the RSI, between sort of 50 to 60, you see the ideal selling pressure coming in, and the MACD lines unwinding to neutral. Aussie dollar. These are all interesting actually, because you've seen the commodities currencies performing pretty well actually, even despite the fact that we had the dollar weakness in the last few days. They've still performed pretty well. And getting on here, you got this interesting resistance though. 76.50 area seems to be a bit of an area where the selling pressure just resumes slightly. Interesting also that's marginally above that on June, but look at the RSI failing around the 60 level fairly consistently. Will we get a continued sort of move on the stochastics higher? Well, I'm already starting to see a bit of slowing in that move. Now this is interesting, this candle here, that candle came on the back of a rate cut from the RBA. Now theoretically speaking, you would imagine the Aussie would be weakening on the rate cut, so that just shows you the strength of the dollar, US dollar, that is selling pressure, that the Aussie actually closed higher on the day. But certainly around 76.50, I think that's where the resistance starts to come in, and it'll be interesting to see if Aussie can make it through there, because that is a pivot line. Old opens and closes here, certainly through late March and also late April, but also here to cap the high mid-July. So 76.50, I'd be thinking about looking for possibly next sell signal. Now the Kiwi is better than the Aussie, stronger technically, but again, it's not really able to breach through these resistance levels around 73 figure. You've had another uptick with that dollar weakness in the last few days, but again, is this an opportunity that the Kiwi has passed up? Because you do have strength. Yes, I will agree with that, but you sort of get a little bit concerned about this possibly turning into the top. So you'd be looking at the sort of marginal bearish divergence or negative divergence on the RSI between the June high and the July high. You've also got the MACD lines rolling over with that. So yeah, this rally, I think, becomes important. If this rally fails, which it may well be doing, you've got a bit of failure there today. If this rally fails and falls over, you could start to see that the selling pressure may well start to come through again. Oh, sorry, I've just sorry, Pan, I've just seen your question. Hi, message from Pan. What if non-farm payrolls is not so good? Well, that would again drive further dollar weakness. And the market is in the process of obviously it's fairly weak against the dollar at the moment anyway, or certainly is near term. And obviously, if non-farm payrolls misses expectations, if the average hourly earnings disappoint, say for example they drop back to 2.6 or even 2.5 on the year-on-year, they would be the two key determinant sort of factors for whether payrolls would be weak or not. So yeah, I think that would be that would drive continued dollar weakness. Question from Ravindu: can you look at sterling yen? Yes, I can. I can do that now for you. GBP JPY equals. Same sort of situation. Oh no, let's do that differently. All those blue lines at the top are old fib levels that have been completely and utterly taken out. So what I'll do just to get rid of that. Actually, these are fib extensions. Wow, I haven't done this chart for a while, obviously. What's a fib extension of? Oh no, that's an old situation that isn't relevant anymore. So that cleans up that chart. Fine. Okay, what are we looking at here? Well, obviously the key resistance starts to come back around so that old low 44.90, 45 area. The rally failed underneath that 43.20, rolled over, as has against basically all all these yen pairs are pretty similar stories, really. Now we had a near-term breakdown on this chart, which probably would show you better on the hourly. So GBP JPY equals, yeah, that is a pretty decent breakdown, top pattern, whatever you want to call it. You'd measure that 4304 back to 36, so about 680 ticks. Say 680 ticks would be 29 area, 29.50, and what's that? Exactly the lows, pretty much bang on. So the breakdown of that top would suggest that we're tracking back to lows, and it would also suggest selling into strength. And it was, and the momentum indicators all back that up. Hourly RSI has picked up back towards 60, but again, MACD lines back towards neutral. I'd say this is another chance to sell. I don't think this is the start of sterling strength. Though you have had a marginal improvement in the last sort of day or so in the fact that its selling pressure has sort of just lost a bit of the impetus, but I think around that neckline, 36, is that 36 figure? It's around about that, isn't it? 36, yeah, 35.97. So yeah, around 36 figure seems to be, and you've already tested that neckline resistance and failed. So that obviously becomes an important level, 136 figure. But to be honest, you'd be still fairly bearish. I think anything up towards probably this pivot line here, around 37.80, 38 figure on sterling yen. You can draw a pretty good downtrend there. That downtrend currently comes in 36.75. So here we see a pretty decent sell zone, I think you'd say, between sort of 35 figure and sort of 36.75. That would help the momentum unwind, which is what's happening at the moment. And I think that that's where we'd start to look for the next selling opportunity, because this is a big top pattern and pretty much the whole outlook is still pointing negative. And I think that would be likely. Right, quickly, if I haven't done gold yet. Positive on gold. I think that's a fairly strong chart. Sorry, I'm actually looking at the daily. Here we see the uptrend channel on gold. Nice strong uptrend channel. Pull back to the breakout, 1306. I'll show you 1306. Where do I show you 1306? 2 years. 1306 was this breakout here from the Q1 2015 high. Breakout above that, pull back to neckline and gone again. That's a strong move. Momentum indicators all positive. Further RSI upside potential, 63 currently. Got to 70, over 70 in the run high to 1375 before. So let's go zoom out, and you can see next resistance 1371, sorry, 1391, and then 1433, which was 2013. So 1391 and 1433 are the next resistance levels. Not a million miles away from 1391 already, but you can certainly tell just on a long-term basis. To show you that, we'll go back 10 years. You can see here we have certainly turned a corner on gold on a long-term basis, and it looks increasingly positive. And I think this is an interesting one now, because for the first time, really, in all those years of bear market run on gold, we're seeing strong technicals, seeing moving averages all rising in bullish sequence and providing support. We're seeing momentum indicators positively configured. We're seeing resistance levels taken out. We're seeing nice breakout above 1306 being used as the basis of support. These are all long-term technical signals that suggest gold is strong. Now, near term, you've seen all these bullish candles in the last week or so. Little corrections are a chance to buy. You'd say 1346 was the breakout level that was then subsequently used as the basis of support Monday and Tuesday. So you've got $10 worth of pretty good support, I think, near term between 1346 and 1355 area, so $9. But I think that's a pretty good buying opportunity if you see it. So this trend higher, I think, is a strong move. Momentum indicators all nicely configured. It pretty much looks strong and solid. So that looks good, I think, generally. So basically, to recap, what is the one key event that we need to be looking for? This week, I think monetary policy from the Bank of England will be crucial. Exactly the consideration of the makeup of monetary easing, it's going to be a rate cut. It just depends on what sort of rhetoric goes with it. I don't think the market is really looking towards a massive stimulus, a massive monetary easing package of quantitative easing. I don't think the market's looking for that. I think the market's pretty much pricing in 25 basis points of rate cut already. But I think that if it comes with rhetoric from Mark Carney that says that we're going to be sort of going for growth generation here through our monetary policy easing program, this is going to be the first of a series of easing measures that you can expect in the coming months. I think if he says something like that, in order to combat the disappointing drop away in the PMIs have a direct feed through to growth numbers, and subsequently the Bank of England is likely to quite significantly slash growth estimates. So they need to use looser monetary policy to try and combat that, and I think that they will say that they will open the dialogue on on a sort of easing program that they're going to put together. In terms of the impact on the markets, direct impacts, think about sterling, think about UK equities. I think they are the key that markets will be looking out for, obviously. But there are other indirect impacts as well. I think gold is an indirect impact if the Bank of England continues to or if it announces strong easing measures. I think gold will have a pop to the upside, and I think other forex majors will obviously be impacted by this this move as well. I think you'd be looking at the likes of the euro, because the market will be looking at the sort of not contagion, I suppose, but you'll be looking for the response from the ECB to an easing measure, or easing program, I should say, from the Bank of England. Would the ECB sit back and allow the Bank of England just to cut rates, and the ECB not respond? I don't think that would be the case. I think Draghi would respond to that, and I think the euro is likely to be hit with that in mind. So thank you for listening today. You can get free research on the Hantec Markets website, www.hantecfx.com/category/research is the URL, although just go through the website. Let me show you the website. Go through the website here, front page, and then click on research, and you come to all the stuff that I post, which is daily morning reports, got media videos, and research, and general aspect of the markets. You can also follow me on Twitter at HantecRich. Please follow me. I will be more than willing and happy to converse with you about markets, and also join our LinkedIn trader group, which is Forex Traders Talk. And with that in mind, I will wish you good luck in all your trading, and I will speak to you again next month. And with that, I will leave you with the disclaimer. So good luck, everyone, and I'll speak to you next time. Thank you.